if you opened your investing app this weekend and felt your stomach drop, you're not alone. Because stocks have just had their roughest few days in months. US tech fell off a cliff on the 5th of June. Then, over the following days, missiles started flying in the Middle East again, oil jumped, and markets across Asia and Europe opened in the red. So what on earth is going on? Why is it happening? And the question that actually matters, what should you do about it? Just a quick reminder, nothing in this video is financial advice. It's purely for educational purposes, and you should always do your own research before making any financial decisions. So let's start with what actually happened, because the numbers are dramatic. On the 5th of June, the US market had its worst day in months. The Nasdaq, that's the tech-heavy American index, dropped more than 4% in a single day, its biggest fall since early 2025. The S&P 500, the main US index, had its worst day since October. The fear gauge they call the VIX spiked by about a third. And it wasn't just shares. Bitcoin slumped below $60,000 and even gold fell. Now, hold on to one fact, because it matters later. Even after all that, the US market is still up around 10% for the year. So this is a hard knock, not the end of the world. So why did it happen? There are two engines behind this, and the first one is geopolitics. The war involving Iran has been grinding on since back in February, and it just flared up badly. Over the weekend, Iran fired missiles at Israel, the first direct attack since a ceasefire back in the spring, and Israel struck back. The big worry for markets is oil. A huge chunk of the world's oil sails through the Strait of Hormuz, right by Iran. Any threat to that, and the oil price jumps. And it has. Oil is up more than 50% since this kicked off in March, back near $96 a barrel. Higher oil means higher petrol, higher costs for businesses, and that feeds straight into inflation. That's the chain reaction markets are scared of. But here's the second engine. This wasn't only about war. On Friday, the US jobs report came out way stronger than expected. Now, normally, good news about jobs is, well, good. But right now, we're in a weird world where good news is bad news for markets. Here's why. A strong economy with high oil prices means inflation could stay stubbornly high. And if inflation stays high, the US central bank can't cut interest rates. In fact, people suddenly started betting it might have to raise them. Higher rates are kryptonite for expensive tech and AI shares, because their whole value is built on profits far off in the future. So the strong jobs report, plus the oil spike, knocked the air out of the most overloved corner of the market. Now here's the part that's useful if you're a UK investor. While American tech was falling 4%, the UK's FTSE 100 barely moved. It finished last week pretty much flat. Why? Because the boring UK market is stuffed with exactly the things that do well in this environment. Oil giants like Shell and BP that actually benefit when oil goes up, plus defensive companies and miners. The thing people mock the FTSE for, being full of old economy, unglamorous businesses, is precisely why it acted like a shock absorber this week. It won't dodge every storm, but the lesson is right there in the data. The UK market and the US tech market do not move in lockstep, and that difference is your friend. Emerging markets are the other side of that coin, and they got hit harder. South Korea, which has been the world's best performing market this year because it's packed with chip makers riding the AI wave, fell more than 5%, hard enough to trigger a temporary trading halt. Markets across Asia dropped too. Right, now let's zoom out a bit. Market falls like this are not rare. They're normal. A drop of 10% or so happens on average more than once every couple of years. It is the price of admission, the long-term returns. What you're looking at right now is a pullback, not a collapse. And here's the uncomfortable truth. Everyone calls themselves a long-term investor when markets are going up. The real test is a week like this one. Because the biggest danger to your wealth this weekend isn't the war or the oil price. It's the temptation to panic and sell. Studies of the last few decades are brutally clear. Investors who stayed put ended up with far more than those who jumped out and missed even a handful of the market's best days. And those best days have a nasty habit of landing right next to the worst ones. Sell in the panic and you lock in the loss and miss the bounce. Don't be that person. So here's a game plan that might make sense. First, make sure you're never a forced seller. The reason people sell at the bottom is they panic, or worse, they actually need the cash. So you want a buffer, an emergency fund. It means a market drop can never force you to sell at the worst possible moment. And it gives you ammunition, dry powder, to buy while everything's cheap. This isn't just me talking, it's close to what the big asset managers are doing right now. The likes of BNP Paribas have turned cautious and are deliberately holding more cash-like, steady assets, partly for safety, partly so they've got money ready to pounce when bargains appear. This week just showed you why diversification is key. If every penny you owned was in US tech, you had an awful few days. If you owned a global tracker, the energy companies that actually gained from the oil spike, and a slice of everything else, that's not boring, that's armor. The single biggest mistake I see is people going all in on whatever's hot, which lately means AI and US tech. Textbook recency bias. One globally diversified fund spreads you across, well, the globe. So no single war, no single sector, no single bad week can take you down with it. Remember, champions aren't the ones who feel great every day. They're the ones who keep training on the cold, miserable mornings when motivation's gone. A falling market is your cold, miserable morning. Keep your buffer, stay diversified, and stay invested. Don't let a scary headline make a decision your future self might regret. If this brought the noise down and made the plan clearer, hit subscribe, and I'll keep you calm and on track through whatever the market does next.